Okay, mic check, mic check. Check the mic, ensuring that we are set to roll out. My camera. Where is my camera? Camera off. Mic check, mic check. 1 2 1 2. Mic check, mic check. 1 2 1 2. Okay, good morning, everybody, and welcome to Technical Analysis Part 2. This is the concluding part of the class. Okay, good morning, everybody, and welcome to Technical Analysis Part 2. This is the concluding part of the class. The class is meant to start at 4 o'clock, and I just wanted to ensure that we start on time, unlike the last time when we had a bit of a delay due to some technical issues. So, granted that we are almost at 4 o'clock, I will be starting the class right on time. And this is how the class goes. So for instance, if you're joining us for the first time and you weren't in any of the last classes, either the first class on Instagram and then the second class, which was a couple of weeks ago, this is basically how it works. All you need to do is listen, of course, and try and take your notes. The materials will be available after the class, both a link to the slides and then other reading guides, other reference materials that you can use for your own development in this particular topic. will be provided in the YouTube link as well, so that you can go and read some more, because I always believe there's so much more information. And don't forget, again, this is a beginner's class, so the idea really is just to get you started in technical analysis. And I can guarantee you that, first of all, that with what you've learned here, you can start to use technical analysis on various markets yourself. And you can start to quickly use that to improve your investing experience. Again, what is the objective of this whole class? The whole objective here really is to help you become a better investor in financial markets, in investment markets, help you become a better analyst when it comes to looking at stuff that is happening in financial markets, so that you don't get moved by every up and down you see in the market, but you can analyze them a lot better. So again, so we typically run this class as a sort of 1.5 hours, 2 hour class. This is the second and the concluding part of this particular topic, and it's going to run for 2 hours. I'm hoping I can get a lot of things done today. What I want to do is basically run through, first of all, a recap of the first class that we did, which will take only a few minutes, and then we're going to dive into the indicators in financial markets or in technical analysis. What are the key indicators that you will use? As a beginner, I'm just going to run through the most important ones, starting off, and then I'm also going to try and run through things like how to trade in different markets, different types of candlesticks, because again, I said candlesticks are pretty much the most important type of technical charts that all technical analysts tend to use in the market. So you really want to understand candlesticks a lot better. There are several types of candlesticks. We're going to start again with the basics, of course, today, and then explain how to interpret those candlesticks, and then talk about other things in the market, like how do you trade in different market conditions? How do you protect your trade in the market? Because when you're trading in the market, you should protect your trade. If you don't protect your trade, then you are liable to lose a lot more than you actually make in the market. And I see that happening all the time with a lot of young people, a lot of young professionals, a lot of young investors that try to come and trade in markets. They come in with all the passion and all the emotion and all the zeal to trade, but they end up losing a lot more, and they get discouraged, and then they stop trading. And then again, I'm going to try and make some differentiation between what it means to be a trader and what it means to be an investor, and how really at every point in time you're not necessarily trading, and I think there's always that mindset when people talk about trading, that people think it's this high world of trading between all kinds of assets. There are different strategies you adapt in different markets, so we'll talk through strategies as well too, and how to test those strategies so that you know that you have a working system, and then you can stick with that system. So that's all that we're going to be talking about today, and I'm hoping also too, as a bit of an addition to this, I have a friend who's a very well-established trader. He has traded in several markets. He's actually based in Nigeria. I hope to have him on a Zoom call, which I will also stream on this training tutorial as well. And we're just going to have a bit of a chat about how to trade in this particular kind of market. When you are in a bearish and volatile market like this, what sort of strategies should you deploy? What sort of strategies should you use, to pick the right kind of stocks? And he was sharing his portfolio with me a couple of weeks ago, and I mean, most of his stocks were in the green, and I was like, wow, you must be doing something right. So I want him to come and talk to you guys as well too, and just show you basically what he does and how he does it. And I think it will be an interesting addition. And if we can't get him on this particular tutorial today, I've sent the Zoom link. If I can't get him today, then I'll try and see if I can get him on some other time, and then we'll just have a chat. Okay, so let's get started with the recap for today. In this particular material, we've been talking about technical analysis. And what exactly is technical analysis? We've said technical analysis is the use of price movements, price charts, historical pricing data, market indicators to understand market movements, identify long-term trends or short-term trends in the market, and then generate viable entry and exit points for investments in financial markets. And that's really it at the end of the day. Really, what you want really is to understand how to pick investments, because and we said, look, technical analysis is the pretty much the oldest form of analysis that is done in financial markets. And it's the senior brother of fundamental analysis. What is fundamental analysis? Fundamental analysis is when you use data, research, reports about that particular asset that you want to invest in to understand the value of that asset, so that you know if you are buying it at the right value for the right price, and if there's any more value that you can extract from buying that asset, if for instance, if it's still going to go up or it's actually going to go down. So fundamental analysis is about establishing value, while technical analysis is really about understanding market trends. Okay, just 1 minute here. Now, again, if you're joining us for the first time, if you have any questions, there's a chat window which I'm monitoring on the side here, and I'm constantly looking at that. So if you have questions as we go along, feel free to ask your questions there. So we said technical analysis is the use of pricing charts, historical pricing data, market indicators to predict market movements, identify trends, generate trading signals for entry and exit from an investment position. That's really what technical analysis is. It's when you're looking at price charts. Fundamental analysis deals with research reports, news, data, and most professional fund managers pretty much use both. In fact, professional fund managers use both. You don't rely on just one. I find that a lot of people, as they start investing, they first of all start with fundamental analysis and they stick with fundamental analysis. The major flaw that we have, that fund managers have with fundamental analysis, is the fact that fundamental analysis is pretty good for telling you about value, but it doesn't tell you when should you buy, when should you sell. Because if you buy, if fundamental analysis says, oh, this particular stock is valued, let's imagine Tesla, or again, I'm always using Tesla as an example, but let's imagine Tesla. It says Tesla is valued at $700. For instance, today Tesla in the market is roughly around $780, $770 per share. Now, the question is, if you buy Tesla at this price, if fundamental analysis says that it's valued at 700, what if the market is actually still heading up, and you could still actually make some value from buying Tesla? What if the market is actually heading down, and the market and fundamental analysis has told you that the value of Tesla is 1,005? Because market movements are not fixed. Market movements could go up or down, and even if the value of something is a certain way, it doesn't necessarily mean that that value and the price in the market will always be in equilibrium. So technical analysis helps you to know when to enter and when to exit by using pricing charts, pricing data, market indicators. Okay, so we ran through this last time we had a class. We talked about the principles of technical analysis, which is based on the fact that human beings are creatures of habit. They tend to always repeat in terms of their reaction to developments in the market. So definitely they tend to behave in a certain way, which is why markets also tends to move in trends that are identifiable: short-term, medium-term, and long-term trends. And that is because human beings are at the core of the market, and they are creatures of habit. History therefore always tends to repeat itself also too, because of that. Now, we also talked about different types of charts. We talked about line charts. These are regular charts that move up and down. The green or black line telling you the market is moving up, and the red portion of the line telling you the market is moving downward. We talked about the point and figure charts, which are really price charts that are plotted against direction and not time, in the sense that all they do is they just tell you if the price is going up or down. They have no second axis that tells you this is the time at which price was going up or time it was going down. It's mostly for traders who just want to understand price movements only. And the interesting thing about them is that they have a box. Each X and each O is set up within a box. So the X represents upward movement, the O's represent downward movement. But that box size, you are the one that's going to set it. And you could set it at whatever currency, at whatever price, or at whatever size you want. So each box size, for instance, could be like 2 cents, it could be like 1 cent, it could be like 50 cents, it could be like 10 cents. And each price movement therefore then follows that. So if there's a 30-cent movement in the market and you have set a 10-cent box size, then the box you will have 3 boxes moving up because the market moved 30 cents up, and market moved 45 cents down, then you have 5 boxes moving down, and that's because you have set the box size at 10 cents. Okay, so that's really what point and figure charts do. I see them used a lot in Asian markets. You also have the bar charts, which give you a lot more information about prices. They tell you what's the high, the low, the open, and the close prices within a trading session. So at every point in time, when there's a trade happening in this particular asset, what was the highest price offered, what was the lowest price offered, what was the opening price at which the session started, and what was the price at which a sale was actually done at the close of that session. That is what bar chart does, and it gives you a lot more information. But the real MVP when it comes to prices or price charts are the candlestick charts. Candlestick charts tell you volume, they tell you highs, the lows, the open, the close. They tell you a lot more about what is happening in the market beyond just that price is going up and down. And that's why we call them the MVP among charts, because that's the real chart that a lot of traders use. And candlesticks are interesting because they come in different shapes and sizes, and that's why today we're going to try and spend some time looking at these different shapes and sizes as well. Another aspect to technical analysis which you should understand is what is called support and resistance. These are psychological price points in the market that become a bit of a floor and a ceiling for prices. They are price points at which, for instance, buyers do not want to buy, or sellers do not want to sell. A support is at the bottom. That is the price at which a lot of sellers feel that the price is already too low, and so they don't want to sell anymore. And what tends to happen is that price charts tend to then touch those support points a few times and keep bouncing back up. As you can see in the chart in front of you, that is a support line at the bottom. The price chart touches it, bounces up, touches it, bounces up, touches it, and bounces up again, and then it hits what is called a resistance. Resistance is like a ceiling. What it does is that's the price point at which buyers do not want to buy because they feel the price is too high. So it becomes a bit of a resistance point in charts. And a lot of what we do in technical analysis is really starts from understanding what the support and the resistance levels are in prices, because they are set at different levels. And the interesting thing about them also too is the fact that a support, once the price chart breaks it, immediately becomes a resistance point, because once price chart has broken it and goes really lower than that, next time it's coming back up, it finds it difficult to break that particular line, and that line becomes a resistance point, because then all the people that have been able to buy at that lower price no longer want to pay a higher price. So they form a resistance at that previous support level, because they want to make profit, so they don't want to buy. They want to buy low and sell high, so they don't want to try to buy again at a high price. So the support typically just rolls over and becomes a resistance point once a price chart breaks it. Now moving on, we talked about different types of chart patterns that you find in prices. Also too, in the last class, we talked about bottoms, which are like supports. We talked about tops, which are like resistance points. We talked about triangles, which could be ascending or descending or symmetrical. And we said the key point to understanding this sort of price chart is you're looking for the breakout point. So if it's a bottom or a triangle, you want to see when the price chart breaks out of that particular formation to decide when you want to buy or when you want to sell. Especially, for instance, with an ascending triangle, you're waiting for the price chart to break out of the ascending triangle, and then you can buy. Or if a descending triangle, you're waiting for the price to break out of the lower support line, and then you can sell. So we also moved on to talk about wedges as well, which are similar to triangles, but the only differentiation is the fact that the lines never really meet up. Unlike a triangle where you can pretty much draw the lines and they end up meeting, with a wedge they tend never to meet. And I gave you an example there with a Tesla chart, which was in a wedge formation. But the interesting thing about wedges also too is that they are signals of continuation. So what that means is that if a wedge is facing upward, it means that price is will continue to move upward. If a wedge is facing downward, it means that price will continue to move downward. But the interesting thing also too is that once there's a breakout of a wedge, then you know that that's the direction that price is finally going, and so then you want to make your trade. It's pretty much the same thing with flags also. Flags are also continuation trends, patterns rather. Once you see them in the market, it means that the market is going in that particular direction. So flags could be upward, they could be downward. The interesting thing about flags is that the top and the bottom line are parallel. And I use example of one of the gold ETFs that I tend to trade here, which is IAU, and that's, you can see a flag formation there. You can see the top and the bottoms are parallel. Now, there are different strategies for trading these patterns, and we'll talk about some of that. We'll talk about that today. So again, if you didn't participate in this particular first class, the video is still up on the YouTube page, so feel free to go watch it. I know if data is a problem, you might want to download it instead so that you take your time to watch it over and over till you understand it. And if you have more questions, feel free to reach out to me on the chat here and ask your questions. Okay, now so we talked about heads and shoulders as well. One of the strongest price patterns you could see in the market, and we said a head and shoulder could be facing upward or could be facing downward. The indication really is that there's about to be a reversal. So whenever you see that head and you see the shoulders, the head is always higher than the shoulders or lower than the shoulders, depending on the direction the head and the shoulder is facing. If it's facing up, then the head is always higher than the shoulders. If it's facing down, then the head is always lower than the shoulders. And it technically means that the market is about to change direction. It is one of the strongest price reversal indicators that you can find in markets. Once you see it, you know that price is about to change, and it typically will trade till it gets to the highest point of its last trade within that same window. So if you're looking at it within a 15-minute window or a 30-minute window, whatever was the highest point within that window, that's typically where it's headed back to. And that's what traders try to use when they're reading heads and shoulders. So let me just quickly move back to this slide here with Tesla, which had Tesla. Where's that slide? This is it. There's technically a head and a shoulder here as well too. If you look at it, there are a couple of shoulders. Let me see. A couple of shoulders. This is one shoulder. This is another shoulder. And this is a head here, which sort of has two heads, really. I've thought about there's a double-headed and triple-headed dragon. Occasionally, you may have like three heads there as well. So, but these are two shoulders, and automatically that tells you that this is heading back to at least this point within this trading window, which is 574. At this point, it was 573. So that's not really too high. But I mean, you may not necessarily want to trade something with such a low profit margin. You might want to look at a bigger window and see if there's possibility for you to trade to a higher point within a different window, maybe within the 15 minutes or a 30 minutes window or a 1 hour window. Okay, so that was head and shoulders, and then the last one we had was cup and handle, which we said is also a reversal trend. But the interesting thing about a cup and a handle is that the neckline are not matched. Unlike a head and a shoulder, don't forget, the neckline should be merged, should be similar for the shoulders, but with the cup and handle, the neckline tends to be all over the place. So you just know that there's a cup and there is a handle. The handle is always smaller than the cup, not as low as the cup, and it could be upward facing or downward facing, but most times we find the cup and handle in a downward facing position, and it's a sign of reversal also. So it means that the market is about to change direction also too. So it's another interesting indicator, or rather chart pattern for market reversals. Okay, so that was a recap of what we did last 2 weeks or 3 weeks ago when we had the second class, when we had stream 2. And today we're going to be looking at indicators. So when you are a technical analyst looking at markets, you're going to use your price charts, and we've talked about different types of charts. You're going to use your price patterns, your chart patterns, which are the different types of patterns we just reviewed that you see in your price chart. And then you're going to use indicators as well. And there are several indicators in the market. Look, if you look at a standard trading platform, you'll probably find up to 50, 60 different indicators. And most of them are usually a variation of one major indicator or the other. So what I've brought here are the major indicators that we use in the markets. And as a beginner starting to trade, these are the key ones you need to understand. Most of the other indicators are usually like variations of these indicators that add maybe one more component or one more extra feature that makes it a lot better, slightly better. So what you want to do is understand these basic ones, and you can start to use these ones as you analyze markets. And once you understand them better, then you can start to advance out into other areas. Now, so what are some of the key ones? Number one, we have the moving averages. As the name implies, what these charts really are just an average of the closing prices of that particular asset that you're looking at over a particular period. But we call it moving average because we are constantly calculating that average as we move along. So for instance, you could have a 5-day moving average. What that means is that we calculate the average closing price of that particular asset in 5 days, let's say from Monday to Friday. And then we also calculate it from Tuesday to Saturday. Then we also calculate it from Wednesday to Sunday, and we keep moving five days like that. And that average that we're calculating keeps moving as we move along the time scale. So what that does is that it's telling us that it's helping us to see what sort of average or trend is in the market for that particular asset. It's telling us what the average range of that particular price is, of that particular asset is, within which it trades in the market. And what that really is telling you also too is helping you to sort of neutralize out all the excess volatility in that particular price. And that way you can have a clearer view of where that particular asset is going towards. So that no matter what an asset is doing, maybe it's just going up to 1,000 and then falling back to 200 and then going back up to 800 and falling to 600, the average minimizes or sort of smoothens out all those volatility and helps you to see clearly this is the direction this particular price is going. And we have several types of moving averages. The two major ones are the ones I have here. We have what is called the exponential moving average, and you have what is called the simple moving average. Of course, the simple moving average is the one I described when I said you just take 5 days and then you calculate the average and you keep on moving 5 days and you keep calculating the average. That's a simple average, a simple moving average. But for an exponential moving average, we also want to factor in what is the volume of what was traded in the market, what was actually sold in the market at that particular price. So we include that in our calculation of the average. So some people would call it a weighted moving average, some people would call it an exponential moving average. But what that does really, it gives you a clearer view of not just the price, but what is actually selling at that price. So that as you're calculating that average, you are seeing what is a real price for deals that is being closed in the market. Okay, so most traders tend to use both. And the wonderful thing about these indicators also too is that you can edit them and you can set what exactly is the duration over which you want to calculate this average. Do you want the average to be based on 5 days? Do you want the average to be based on 15 days? Do you want the average to be based on 30 days? Do you want the average to be based on 50 days? Whatever you want to set it at, you can edit this indicator and you can set the duration for that average as it moves. So for instance, you could have, and the way most traders use it, let me just tell you simply, is they use a 200-day simple moving average and then they use a 5-day exponential moving average. Again, I'll take that. They usually use a 200-day simple moving average so that you have a clear view of the long-term trend in the market, and then they take a 5-day exponential moving average, which gives you a very clear view also too of what is happening in the market within shorter periods of time. Okay, and those two moving average tends to help you generate trading signals even as you use them by themselves also too, because we're always trying to understand if the market is changing direction. If the market is changing direction from its long-term trend, then you would see the exponential cutting the moving average either heading down or heading up. Otherwise, they are typically in the same direction. So for instance, in this particular chart, which the point that is circled is a sign of the exponential, which is the blue line, is cutting the simple from the bottom, and it's telling you that market is changing direction and heading upward. And some people use that as their main trading signal, that once that happens, in the market, we call this a golden cross. This is a sign that long-term trend is about to change and you need to jump into the upswing. There's a golden cross when it cuts it from the bottom, and then there's a dead cross when it cuts it from the top and it's heading downward. Okay, so that's really a sign that, okay, market is about to head downward. And if you look somewhere around here, if you can see my mouse, that is a dead cross happening there, and you can see that after that market changed direction and headed downward. So usually these are good signals that almost every trader I know has on their charts. They have a 200-day simple moving average and a 5-day exponential moving average. Okay, moving on. You have the MACD. The MACD is a momentum or a volatility measure. What it does is it tells you the amount of selling pressure or buying pressure that exists in the market for that particular asset. So you see that it has, similar to our moving average, it has those two lines also too. And in fact, just let me tell you the name of MACD. MACD basically means moving average convergence divergence. Moving average convergence divergence. It's a longer name, so most of us, everybody just calls it MACD. And some people even call it MACD. So the MACD tells you, if there is a strong pressure to buy, or there's a strong pressure to sell, or a low pressure to sell, or a low pressure to buy. And you can see that in the histogram or the bar chart that you are seeing at the bottom here. That is measuring the pressure for buying and selling. Sometimes that chart is really high, sometimes it's really low. Like you can see, if there's a high buying pressure, or a high selling pressure, or a low buying pressure, or like here, a low selling pressure, it could even be much lower than other parts. So you can see that tells you that there's not a lot of interest in buying or in selling at this point in time. And so most traders also too typically use an MACD to measure that volume, because if you want to jump into the market or you want to enter the market at a certain price, then you need to also weigh how much could market really move. What's the selling pressure or the buying pressure like in the market for that particular direction you want the market to go. For instance, if you are going long, you're buying, or you're going short, you're selling. You want to know if there's a lot of selling pressure, or you want to know if there's a lot of buying pressure. It helps to buy when there is a lot of buying pressure. It helps to sell when there's a lot of selling pressure. It really helps. And that's where MACD really comes in to help you. It also has that moving average line. And the interesting thing is you can combine both the moving average in your price chart and then have the MACD at the bottom to also further buttress your signals. Okay, another interesting technical indicator is from a class of indicators we call stochastic oscillators. Stochastic oscillators are basically indicators that measure how close a price is to its support or to its resistance. And if you don't want to waste your time checking what's the support or what's the resistance, you can just have a stochastic oscillator like the relative strength index. There are several of them, and I'll show you that later in the segment in the material. You can have the relative strength index, or you can have the commodity channel index, the CCI. There are others as well. Those are the two I've traded with in the past. The RSI is pretty good because it has two major lines. So at the bottom here, you can see it has what is called the overbought line. So when an asset enters the overbought line, that typically means that the selling pressure has dropped and this asset is about to start to crash. Okay, there isn't a lot of pressure to keep it at that point. Once it enters overbought, it's about to crash. And then at the bottom, you have what is called the oversold line. Once it enters the oversold line, then it means that this asset has gotten to the bottom and is about to start to rise. Okay, so it's measuring the selling pressure. It's also telling you how close it is to a support or a major resistance. And it's telling you, okay, this may be a good time to enter or a good time to exit. Okay. And so you can use that in conjunction with your MACD to see that, okay, I think the selling pressure is down. This asset is now particularly oversold and it's time to see it reverse. And it helps when you then combine this with your chart patterns to see that, okay, I think there's a double bottom here. This asset is about to go up, or there's a head and shoulder facing downward here. This asset is about to reverse. So all these indicators, adding them together gives you a lot more assurance to take the right decision when you want to buy or when you want to sell. Okay. Still moving on. You also have what is called the Bollinger Bands. Bollinger Bands are interesting in the sense that what they are you can see those two lines on both sides of the chart. You have the purple line at the top and the yellow line at the bottom, and then there's a blue line going through the middle. Now, again, this is interesting because these, again, are moving averages, but the Bollinger Bands, that the middle line is a moving average, but the two lines on both sides are actually volatility measures. They are measuring the amount of volatility in the market. In other words, what is the standard deviation in prices that we are seeing? In other words, from the average. If the standard deviation from prices is increasing, then the Bollinger Bands will expand. If the standard deviation from the average that we're seeing in the market is reducing, then the Bollinger Bands will contract. So what are people offering? What are people saying that they want to sell at or what they want to buy at? That is what the Bollinger Band is measuring. It's taking the average and then it's measuring immediately, it's measuring the standard deviation from that average. And it's saying, wow, people are offering really wide range of prices in this market, or people are offering really really low range of prices in this market. And that volatility is good information for you because the higher the standard deviation, the more the market could swing upward or it could swing downward. So typically, I know traders who are Bollinger Band specialists in the sense that they only trade off Bollinger Bands. Typically, a Bollinger Band will generate signals when the price chart touches either the top or the bottom. So for instance, you will notice that once it touches the bottom line, what happens? It jumps up. Once it touches the top line, it tends to come down. This is particularly one of the interesting stock that I have come to know in this Canadian market, which is Franco-Nevada. It provides pipeline and all sorts of technical services for oil and gas companies. And you can see from the price chart that once it touches the up line, once it touches the top part here, it goes down. Once it touches the bottom line here, it goes up. Yes, it still comes down, touches again, but it jumps up immediately. Touches again, jumps up immediately. Touches the upline, goes down immediately. Touches the upline, goes down immediately. Touches the upline, and at this point when I took this particular chart, it was still touching the upline, which means the next direction will be what? Downward. And I'm sure if we check it on any other trading platform right now, you probably see that it jumped downward after that point. So it's also a good signal that you can use to decide, okay, I think I need to short this particular stock and sell it because it's heading downward next, or I can hold on and see what the longer term trend is. There are traders that trade with Bollinger Bands and trade off Bollinger Bands. It's pretty interesting as well. That's another indicator. And then the final indicator, which I will touch on, is the Fibonacci retracement. Fibonacci retracement just automatic. If you don't want to waste your time looking for what are the support or resistance points in a particular market, the Fibonacci retracement just automatically tells you these are all the support points, these are all the resistance points in this particular asset. Once you select Fibonacci retracement, instantaneously it brings up all these price points to tell you what are the major support points in this particular chart. Now, the 0% and the 100% line are not really your focus. The major focus for you are the 23.6%, 38.2%, and all the lines basically those lines in between the 0 and the 100% points. Those are the major trading support points or resistance points in this particular chart that you want to focus on. Okay, so if you don't want to waste your time looking for, where's the support or where's the resistance, just select Fibonacci retracement. It throws up all these lines to tell you where the major, and of course the strongest is the 50% line. Okay, the 50% line, that's where you want to pay the closest attention. That's where either there's the largest support, which is tending to draw prices down, or the largest resistance, which is keeping prices from rising higher. In this case, it's a major support point in the sense that prices are constantly attracted to go down to that point. So we've seen this price chart touch it a few times, come to that point a few times, even broke it once, rose past it, but it's heading back down towards it again. So it seems to be a major support point. And what that indicates is that this particular chart may not be heading upward sooner. At this point, it actually broke it and even rose past it again anyway. And it's going to form another line. So it may be a major point where if you ever see price at this point, you want to be able to get in because you know either this is now the new support and it has bounced off it, so it's heading elsewhere. Now, Fibonacci is interesting because it's a mathematical calculation. It tells you, based on mathematics, where the highest pressure has been at for this particular asset, for the price of this particular asset. It tells you that, and you can see that from the chart that is provided. Okay, so that is the Fibonacci retracement, and those are the key indicators. At this point, let me ask if there are any questions. Please feel free. There's a chat window. Just ask your questions, and we'll be glad to answer them in the chat window. Okay, moving on. Then you have candlesticks. Let's talk about the different types of candlesticks that you have. There's the hammer, there's the spinning top, there's the doji, there's harami, and there's marubozu. Marubozu, don't forget the origin of candlesticks is Japanese, and that's why you have all these Japanese names for candlesticks. Some of them have been translated into English, but it sort of just retains a bit of a flavor of the origin when you use the Japanese name. So I tend to use the Japanese names. Everybody's always talking about doji, harami, marubozu, the Ichimoku, and so on. So we can talk about all that, but let's dive into it. So let's start from the beginning. I said that candlesticks, because of this sort of nature they have, where they give you more information about prices, they tell you volumes, they tell you the high, the low, the top open price and closing price. They tend to be the preferred chart for people that are technical analysts and even for real traders or fund managers in the market. So let's talk about that in a little more detail. Just 1 minute here. I'm gonna try and sort out something. Excuse me, I'm going to quickly put us on break for a minute while I sort out a bit of a technical issue. Oh, okay, cool. Okay, we're back. Mic check. We back? Yes, we are. Okay, I see some questions. I see just one comment here by Maximus, who says that thanks to Alpha, it's been great thus far. However, I want you to talk about alpha beta stuff you mentioned in stream 2. Okay, that was from the previous class, and I talked about those that are come to the market to seek alpha and those that use beta, smart beta as well in the market. Okay, good. That's on the fundamental side, and it's a very good point, which I will address when I come to fundamental analysis. Now, there's a page here where I actually talk about adding fundamental analysis to your analysis. So, like I said, you don't just depend on just technical analysis or just fundamental analysis. You need to combine both. So, even as we understand technical analysis here, I'm going to talk about how to add fundamental analysis to your analysis of the market, and there I will talk about alpha and beta. So that would be that's an interesting question. I would definitely touch on that. Okay, so if we continue with our class here, Grammarly. Okay. Okay, guys. So let's talk about let's understand the candlestick a little bit better. Investopedia is one of the sources I use for these materials. So feel free to go to Investopedia. There's always a lot of information on Investopedia, both for beginners and for advanced level. Okay, so this is what a candlestick typically looks like. So typically it will be black, or it will be red or green. Okay, but for illustration purposes, I'm picking it and leaving it in black. Now, the candlestick has two major parts. It has the body, and then it has that long stick through it, which is called a shadow. The body of the candlestick typically tells you the volume in the market. Okay, if it's green, it tells you that there is more of a buying volume in the market, and if it's red, it tells you there's more of a selling volume in the market. And also, it tells you what the day's high is, and it tells you what the day's low. That's the lowest price in the day and the highest price in the day. The open price of the day and the price at which that particular trading session closed during the day. So it's quite informative. It gives you a lot of information, and I think that's why candlesticks are really the preferred chart among traders. Now, the key types of candlesticks you would tend to find in the market, which also tell you if there's a bit of a bullish pressure in the market or bearish pressure in the market, are the ones you see here. You have the Marubozu at the end of the first candlestick you're seeing. Of course, I'll come back into I will describe all this a lot better. But you have the full bar, which has no shadow. That is usually the strongest sign of a bullish trend in prices. And then you have the other type of the second chart, which has a bit of a shadow, but still a lot of pressure on buying side, which is very strong. Then you have that, which is also strong. And then you have the fourth one, which has a shadow both at the top and the bottom, and a bit of buying pressure in the middle. This is also a good sign of a bullish strength in the market. And then you have the neutral, which could be green or could be red. Okay, that is usually neutral. It just tells you that the market there's no clear direction in the market. Okay, then you have pretty much the reverse on the selling side. You notice that here we have the bullish bar at the bottom telling you that the market is heading up, but on the selling side we have the bullish bar at the top telling you that the market is heading down. Oh, sorry, we have the volume bar at the top telling you the market is heading down, but it's red. So the differentiation is color is very key. When you see in the candlestick chart, you see something looking like a hammer like this, but facing downward, then you know that you are in a position where the market is about to turn downward. And then when the main body is this large, but still at the top, market is heading down. And then you have the full bar, which has no shadow. That is the strongest bearish sign telling you that the market is really heading downward. So that if you're looking at a candlestick chart like this one, you can increase the size, or you can look at it a lot closer, and you can see the different types of candlesticks that are showing, telling you, oh, this is where the market is heading, or this is where the market is going. Okay. Now, what are the different types of candlesticks you find? Let's look at them in details. Number one is the first category is what we call the, I should have changed the name here. The first category is the one we call the hammer. Hammer time. Marubozu. Okay, so the first one is what we call the hammer or the hanging man. Okay, you can see that the hammer is green and then the hanging man is red. Okay, so if it appears at the bottom of a downtrend, we call it a hammer. So when the green bar is at the top in a downward trend, in other words, the market is heading downward, and you see a green bar at the top of a long shadow like that, that means the market is about to change direction. Okay, but if you see it at the top of an uptrend, market is moving heading up, and you see either a green hammer or even a red hammer, that means that the market is about to change direction and go downward. Okay, so that's typically what you find in candlesticks. That's why candlesticks are even very interesting. You could also go see a spinning top. That is when you find the shadow in the middle of a long, rather you find a small body in the middle of a shadow. A small body in the middle of a long shadow. It's either a small body, slightly larger, or whatever size. Typically, it's a sign of continuation. It's showing that the market is still continuing in that particular direction. So you could see that in the middle of an uptrend, or you could see it in the middle of a downtrend. A spinning top is not a very, very strong signal that market is changing direction or anything. That's why you find it here. It's not the strongest of its. As you can see, it's pretty close to the neutral. It's not the strongest of signals, but it just tells you the market is heading in. This is the direction market is heading. So if it's green, the market is heading up. If it's down, if it's red, the market is heading down. But it's very close to. It's more close to neutral than you know. And then you have the Arami. The Arami is really just Japanese for mother and child. And what it means is that it's also a reversal sort of direction. You have a large, body with a shadow on both sides, but you also have a different color of the same type of candle. So you can see that there is a large body here, and there's a long shadow at the top and at the bottom. But there's also another similar one, which is also similar in terms of the large body and a shadow at the top and at the bottom, close by, but of a different color. So once the mother gives birth, a red mother gives birth to a green child, you know that direction is about to change. It means we're going up. Once a green mother gives birth to a red child, then you know that the direction is about to change and we're going down. So you have what you call the bullish harami and the bearish harami. So you also want to look closely at your candlestick chart when you're using candlesticks, because you could be looking at a bullish harami or a bearish harami. And then the last one, which I'll talk about today, is the Marubozu. And by the way, I didn't mention this, but this neutral chart here that you're looking at is what is called the doji. Doji is the neutral chart. But interesting thing about doji is, as you start to go into the advanced class, largely it is neutral. But when it's combined with some of the other candlesticks, it could be a bearish doji, it could be a bullish doji, it could be an engulfing, bearish engulfing doji, or a bullish engulfing doji. It could be a shooting star doji, or and so on. So there are all kinds of. We don't need to bother about all that right now. At the moment, you only need to understand that it's neutral. And really, it has to be combined with something else for it to have any other connotations of upward movement or downward movement. Okay. And then the Marubozu is the strongest signal of a particular trend. So a full bar with no shadow is what we call the Marubozu. Marubozu is a full bar with no shadow, and it just tells you that, if it's red, then we are in a strong downward trend. If it's fully green, then we're in a strong upward trend. Okay, so those are the different major types of candlesticks that you typically find in a candlestick chart. Those are the major types. Most of the other types you will talk about in an advanced class are combinations of these types, the Arami or the shooting star or the engulfing, bearish engulfing or the bullish engulfing, and so on. All those are basically modifications of these basic ones. So once you understand these basic ones, that this is what they mean, then you can understand those ones also too without much complication. Okay, but for sake of time, we won't be looking at that. So the question is, now that you understand all this about technical analysis, you know the different types of charts, you know the different types of basic types of chart patterns, you know the different types of support resistance, you know the different types of indicators and different types of candlesticks. How do you combine all this together when you actually want to select a stock that you want to trade, or an equity that you want to trade, or a ETF that you want to trade, or a commodity you want to trade? Because don't forget, all this technical analysis is usable for any type of market you want to trade. Do you want to trade on equity? Do you want to trade on commodities? Do you want to trade on currencies? Do you want to trade on cryptocurrencies? You can use technical analysis in any of these markets. Okay, are you trading an ETF or a fund or a fixed income security? Technical analysis is usable in any of this market. Are you looking at oil prices or gold prices or copper prices or Bitcoin price or ETH price or Litecoin or DAO or whatever asset you're trying to trade? You can use technical analysis. But the question is, so how do you combine all this information together? What's the best way to go about it? Okay, because I mean, is this how you want to set up your trading view, so that this is what you look at? For instance, look at this particular trading view. This is the trading view for someone who is trading Zella. And I mean, Zella here is just an equity on the American Stock Exchange. Interesting equity, one of the most active equity in the last 2 weeks. There's been a lot of trade in this particular equity, and it's been heading up. In the last week alone, I think it's done close to, what's that? It's done close to, yeah, it's done close to 26% in the last 30% in the last 1 week, and that's a significant upward trend for this particular security. So what that means also too is that there's a lot of pressure either on the buying side, and you can see at the bottom there's an MACD chart telling you that there's a strong buying pressure. If you look at the Bollinger Bands, it's pretty wide towards this later part of the chart. And if you look at the RSI, but if you look at the RSI has gone to the oversold region, and that's why it changed downward, and you can see that the price chart is also heading downward. Now, one of the things you should know about RSI, which is at the chart at the bottom here, is the fact that once it's trading in the middle, there is no clear signal. You typically use an RSI when the chart is touching the overbought or the oversold. That's when it's giving you a clear signal of what is happening in this particular market. So now, is this how you want to set up your trading view with all the indicators? I mean, this guy has a moving average, he has a simple moving average, he has the exponential moving average, he has the Bollinger Bands, he has the MACD, he has candlesticks, he has RSI, he has all that, and it could be confusing when you have it all set up like this. So as you start off, one of the ways I like to tell people is, the best way to start up really is, you have your simple chart, okay? You have your chart, and then you pick one moving average indicator. It's either you use the simple and exponential together, or you use just the MACD, or you use the Bollinger Bands, because the Bollinger Band also has a moving average in the middle. So you can pick just one from that combination. It's either so you have your chart, quite all right, and you're looking for your chart patterns on your chart. Then you add a moving average indicator. So you could use simple and exponential, because you have to use those two together. And then you use an MACD, or you use Bollinger Bands. Then you also add a stochastic indicator. You could use the CCI, which is pretty much the same thing as the RSI. It's also telling you overbought and oversold. Or you use the relative strength index. You don't need to combine all of them together. Use the CCI, use the relative index, use the MACD, use the Bollinger Bands, use the exponential, simple moving average, and then start still looking for your chart patterns. It gets too confusing. You want to get a clear signal. And that clear signal will come when you have a clear idea of which particular combination you are using. So your chart, one of the moving average combinations, and then one stochastic indicator. Now, once you decide on the combination you want to use, then you need to do something called backtesting. Backtesting basically means that you need to now take that your combination that you have decided to use and then move your chart back to a previous time period. And try to check if using your combination at an earlier date, would you have been able to generate a clear trading signal based on that your combination, and what would have been the outcome of a trade if you had made a trade based on that trading signal. Okay, so what you want to do is take, for instance, you have decided to use the MACD and the RSI. Okay, you have decided to use the MACD and the RSI on your price chart, and if we take out all the other ones and you have just a clear MACD, you move this chart back to a different time period. You just basically, on most trading platforms, you just need to select the chart and just drag it across the screen, and it will keep moving backward to a different time zone. And once you drag it across the screen to your time period, to a different time period, maybe to last year or 2 years ago or 3 years ago, check to see if using your combination, where are the trading signals you generate? Does it generate a clear signal that, oh, this is a good point to buy? The MACD shows that there's a selling pressure here, there's a buying pressure here, and the RSI shows that it is oversold, so it is a good time to jump in. And then you actually check if you bought at this particular price here. Let's say you bought at this price where I have my mouse. This is the amount of gain you would have made at the max. Now what you want to do is you want to check this your combination and also check what is the maximum gain or loss you could have made over in that particular trade, and check it several times. That begins to give you a clear idea of how good your trading combination is. So that if the trading signal is not very clear, or it's not really generating any trading signal, then you know that you don't have your combination right yet. But let me tell you something. In choosing your combo, I would advise you to always have the simple and exponential moving average, the 5-day exponential moving average and the 200-day simple moving average. That always helps. Whether you use the MACD or not, after that, it's your choice. But that combination of the simple and the exponential always generates a good trading signal. It's either that, or you use the Bollinger Bands, like I told you as well, where you look at when it touches, and when it touches either the lower line or the bottom line. Okay, now those are two good options that a lot of experienced traders use. So you could use the simple moving average or the Bollinger Bands. The MACD is also clear. It also gives trading signals at the point where those two lines cross. That's also a signal as well of buying or of selling. Let me quickly show you what I mean. If you go to the MACD line, let me just quickly show you that. Okay, good. So here, where you have the yellow line, which is the positive line, and I should have changed the colors, but you have the blue line, which is the negative line. And so once the yellow line crosses from the bottom, the blue line, it generates a buying signal that it's time to buy. Okay, and when the blue line crosses the yellow line, it generates a buying signal that it's a selling signal that it's time to sell. Okay, so you can see that the yellow line, I'm mixing this up. Sorry, the yellow line is a signal line. So when it crosses the blue line from the top down, then it's time to sell. When it crosses it from the bottom up, it's time to buy. Rather, the yellow line is the one that gives you the signal. When it crosses it from the top down, then it's time to sell. When it crosses it from the bottom up, it's time to buy. So, and then the selling pressure is there to tell you how much of a gain you can actually expect. Okay, so I think that's pretty interesting when you're using the MACD. That's how it generates its own signal. That you have that signal line, which is the yellow line, which is telling you once it crosses from the top, it's time to it's heading down. And when it crosses from the bottom, it's heading up. Okay, that's different from the moving average line, which is really a case of when the exponential crosses either from the bottom. So, and I told you about this when I said it generates a dead cross or a golden cross. So for instance, when the exponential moving average, which is they use 50-day here, 50-day moving average,
the 50 and the 200, they're using 50 and 200, it generates a dead cross when the exponential cross cuts from the top. It cuts the 200-day moving average from the top. That's a dead cross. It means the market is heading down. And when it cuts from the bottom, it means the market is heading up. That's how you use the exponential and the simple moving average. The exponential in this case is a 50-day moving average, while the simple is actually a 200-day moving average. So that's how it generates the dead cross and the golden cross. Some would use 5 days, some would use 50 days. 50 days might actually be more preferable. And this is an Apple Inc. chart that we're looking at. So, and you can see that this actually generated a significant trading opportunity. Once that dead cross happened, the market went into a really long bearish trade. And if you had patient capital in this market and you bought this particular stock after it generated that dead cross, you know that it's heading, or it's going to stay down for a long period of time. So you would have sold in that market instead. It should have been a shorting position instead in that market. And then when it generated the golden cross, that would have been a buying trend. Okay, so again, on combination and back testing, choose your right combination and back test it. Go back in time and check using your combination that you have decided what was the signal generated and what was the amount of gain or you could have made going up or going down, and what was the potential loss you could have made if you using it. And then test that several times so that you have a clear idea of, when I use this signal, this is the maximum amount of gain I can expect. So that also helps you to then to set your expectations on your profit target. Okay? And especially when you use it for the same stock over and over, you get a clear idea of how that stock moves and how to trade that particular stock or asset class. Okay, let's move on here. So how do you add fundamental analysis? Because it's important you trade not just with technical analysis, but also use fundamental analysis. Fundamental analysis is when you use research reports, you use data, economic reports, all sorts of information that is hard facts to get an understanding of the value of that asset that you are trading. There are different ways. You can use fundamental analysis through research reports. For instance, let's imagine you want to trade gold. There are analysts that actually write research reports about gold. A lot of analysts that write research reports about gold. There are a lot of institutions that write research reports about gold that you can find online. There's a lot of news about the gold market because a lot of central banks still stock up on gold just to ensure that they have, a good value for their currency. So, for instance, over the last year, Russia and China have been buying a lot of gold, and that has helped gold prices up. India as well too. And then, of course, gold also has ornamental value in the sense that it's used for jewelry. So, gold is something that I'm always interested in. Back when I used to be a trader, I used to trade gold as well. And crude oil. So gold is pretty interesting. So there are research reports about gold. There's a lot of news about gold. And so you can go online, and I've provided some links here, some sites here where you can go. Reuters is always reporting. There's most news sites, especially financial news sites, have a page dedicated to commodities, have a page dedicated to financial markets or investment markets, which you can go and read up about. And Reuters is one top one. Market Watch. Like, if you are a trader in the market, if you are an investor in any market, if you are investing in any market globally, US market especially, you have to be reading Market Watch. Market Watch is very key. Market Watch has news wires that alert you to what's happening in an economy as it is happening. So it's always key that you're logging into Market Watch and you're reading the news on Market Watch on that particular asset or sector that you're investing in. Market Watch is very key. Bloomberg as well. And if you have access to a Bloomberg terminal at work, that's even the best. Bloomberg is also fast, like Market Watch, news wires, telling you what's happening in the market as it's happening, also telling you about what's happening in that particular sector over a longer period of time. Different news. You can also just read on the Bloomberg website.
Bloomberg website will also provide you with equity research as well too. There's a lot of equity-based information on Bloomberg website. When I tell people that, look, if you want to buy any asset in any market, just go to Bloomberg or go to Yahoo Finance and type in the name of that security, and you can see tons of research on what they think is the actual value, what different analysts in a lot of different firms are saying about that particular stock. Bloomberg is very good for that. Yahoo Finance is very good for that. FinViz, which is my screening app, my screening site, is also very good for that as well too. I'll talk about FinViz later. You can go to FX Street. FX Street is interesting. The major thing I like to go to FX Street for is FX Street has something called fxstreet.com. FX Street has something called an economic calendar. It tells you when different CBNs and around the world are making an announcement about their interest rate, about their major rates, when different data from different economies are being released. Unlike what we find in Nigeria, where we don't have a lot of our data on a schedule of how they are going to be released, most economies around the world have a schedule. So you know when housing, the amount of housing starts, data is going to be released in America. You know when non-farm payroll, when all the salaries, when all the indications of salaries in America is going to be announced. That is the day we usually call Black Friday in the market, because that data is very sensitive to the American economy. It tells you how much unemployment there is in the economy, how many people are employed, how many people are not employed, what salary ranges are, if salaries are going up or going down, and so on. Non-farm payroll is very critical. It comes out on the first Friday of every month. And so, for instance, this yesterday was non-farm payroll. It was May 1, but also non-farm payroll. And so it's sensitive, and you can find that on FX Street. FX Street has the economic calendar that tells you when that data is coming out. So I usually just have that open on one side, and you can just see. It will tell you, it goes economies like Russia, Australia, Japan. It reports all of them. So it's also a very good site to look at, especially if you're trading commodities or you're trading currencies. You need to know you need to be looking at that. Google is your friend, as they say. Also Google as well. Finviz.com is also fantastic, and I'll talk about that in the next page. Finviz is great for screening. It helps you to select stocks, because you need to screen stocks, and I'll talk about screening next. But Finviz is great for that. They also have access to a lot of equity research. So if you type in any equity, it will bring out the price chart. It will bring out all the financial data about that equity. It will bring out all the financial reports or research reports that have been written about that equity. It will also bring out, recommendations that whether you should buy or sell and so on, and potential, risk that you could be exposed to in buying them. Finviz is fantastic for that. And of course, if you're a fund management professional, you know Morningstar. Morningstar is a subscription website that has access to all the actual research reports from different houses about particular equities, about markets. It's also fantastic. Investopedia, I've talked about that. I've talked about seeking alpha. Now, the thing about adding fundamental analysis to your technical analysis is, what sort of approach do you want to take to it? Do you want to do a top-down approach where you start with a country and then you narrow down to a particular sector you want to invest in that country, and then within that sector you also want to understand what are the top performers in this particular sector, and then you narrow down to one of the top performers, and then you start to read research about that particular top performer, and then you start to look at the price chart and you start to decide, okay, this is the one I want to buy, and this is when I want to buy, or this is the entry price I want. That is how you can add technical research. Or you can do a bottom-up approach where you actually just pick a particular company, you do your technical analysis first, and then you start to add the fundamental. You start to read about the country, you start to read about the industry, you start to read about the country within which that company is operating, and what are the prospects of that particular company. So it could be either ways, top-down or a bottom-up approach. Okay. Now, if we can talk about the alpha beta thing I talked about earlier. Now, so there's actually a website dedicated to this called Seeking Alpha. What a lot of market professionals believe is that stock prices react to a lot of things. They react to news, they react to developments in the particular company, they react to policies by government. But there's usually a variable that has the strongest impact on the performance of that particular stock. And if you get to know that variable, then you can decode to a larger extent how that stock price is going to perform, because you know that this is the variable that has the largest impact on that particular stock price. That variable is what we call the alpha. So if you are someone that understands mathematics or economics, it is like an equation. We believe that the stock price is a dependent variable y, and y is equal to a plus bx, where x are x and b. X is the variable, is one of the variables that affects the stock price, and it's one of the major variables that affects the stock price. But there's also an independent variable called a, which is the alpha, that also has a strong impact on that particular stock price, which is y. So, and I know I'm getting into the mathematical realm here, and that's why this is really something in the advanced class. But alpha basically means a variable that we believe is independent of that particular stock price, but it affects it significantly. So it could be government policy, it could be something, but you need to know what the alpha is. If you understand what the alpha is for that security, it will help you in decoding how that stock price will behave a lot better. So there are professionals that are constantly looking to find out what exactly is the alpha for this particular asset, or for this particular equity, or for this particular currency that I'm trading. That's what we call them. That's why that website called Seeking Alpha is dedicated to that. Understanding the in-depth is a type of fundamental analysis, trying to understand what is the major variable, the one variable that actually has the largest impact on this particular asset that I want to trade. And it could be anything. But there are those who then believe that, look, it's not a case of which variable affects this stock price the most. It's a case of the market in which this stock or this particular asset trades. So don't forget the equation. The equation is y is equals to a plus bx. The b is what we call beta, or beta, beta, however you want to pronounce it, potato, the beta. The beta is actually a measure of how the stock price reacts to the market. It's a measure of how the stock price reacts to the market. There are stocks that if the market is going up, they're also going up. If the market is going down, they're also going down. In mathematics, we would call it the slope, or we would call it the correlation, okay, of that particular stock with the market. So stocks that have a high beta move closer to the market, in the sense that when the market is moving up, they are also moving up at the same pace or even higher. While a stock that has a low beta would also be one that when the market is moving up, it doesn't move as fast as the market, and the lower the beta, the more it is even independent of the market. So a stock with a low beta may actually be moving down when the market is moving up, or moving up when the market is moving down. Or it just doesn't move at the same pace, so it's slower. So there are people that rather than start looking for alpha, they are trying to understand what is the beta of this particular stock as a way to pick stocks, in the sense that, for instance, like right now, the market is moving down. The market has been bearish, right? If you picked a lot of low beta stocks into your portfolio, even though the market has gone down a lot, your portfolio may not have gone down so much, because your stocks do not move in the same direction as the market. They don't move downward when the market is moving down. But the flip side is that if you pick a lot of low beta stocks in your portfolio, when the market is now moving up, then your stocks will also not move high a lot. So you need to understand. So, and that is why in trading, there's a lot of management also too. In the sense that you know that when the market is going into a bearish turn, I need to quickly buy a lot of low beta stocks into my portfolio so that they don't move as low as the market is moving. And as soon as the market is recovering, I need to sell those low beta stocks and buy a lot of high beta stocks, so that as the market moves up, my portfolio also moves up with the market. So that is it about alpha and beta. So that is it really about alpha and beta. So I can see some questions here. Maximus is asking, do you use the volume bars on the chart body for trading decisions? Well, you know what? In themselves alone, they are not enough information. While the volume bars will tell you that, in a candlestick will tell you that there is either a high volume or a low volume, it's not enough information. See, I like to get confirmation from, for me, I like to get confirmation from at least a chart pattern and 2 indicators. That's what I like to do. And that's what I recommend for a lot of beginners. Look, I like to get a confirmation from at least 1 chart pattern and 2 indicators. Sometimes you may even have 2 chart patterns within the same chart. You will see a clear cup and handle, and you will see a very clear, triangle as well. And you know that, okay, this is a go, and you got to go. But just confirm also too with a moving indicator or a moving average or with an RSI that, okay, we're in a good zone. So, for instance, when Tesla was 200 in 2018, was in the 200 range. I told my friend, you probably know him on Twitter as Manasseh or Knight of Delta. He runs an investment firm. I said, look, we got to get into Tesla. Tesla is heading up. I can see a good long trend here in Tesla, and we both got in at 200. Tesla rode up to 900. By the time people were shouting about Tesla, when Tesla was 600, we had been in since it was 200, and it went up the way up to 900, and then turned around. And then when it got to 400 again, I told people, I said, look, I can see a clear signal for Tesla. It's 417 right now. It's heading back up again, and that was the recent trend that we saw when it got all the way to 800 again and headed back down. So for me, it's safer to go that way with a clear chart pattern and 2 trading indicators. Don't trade on just the volume bars. Don't trade on just that. It's a good sign that there's pressure in the market, but don't trade on just that. Someone says, Edge. Oh, nice one. Hedge Connect FX is nice one from Finicky Days. Oh, you attended that Finicky class. That's interesting. I used to teach on FX and way back. I started teaching on FX back in 2011, or was it 2010 or so. So there's still a lot of people from that particular class here. I see that I have someone at the door. Can you just hold on a minute? I'll just respond to someone at my door. Hi, Margot. What's going on? Hi, Margot. Can you hear me? This is Ella's dad. She's not up yet. She's still sleeping.
Hi, Dad.
Sorry, hold on a minute. Class, I'm just going to pause the class briefly. One of my daughter's friends is at the door. Okay. Hi, how's it going? She's still sleeping. Yes. Okay, let's wait for her. I know, sorry, I know you're early, right? I was looking through the camera so I didn't see you early. You're early, right? Early. Sorry about that. Okay. What? Yeah. Okay, enjoy your ride. Oh boy, sorry about that. Okay, I think we're back. Okay, good. So, someone is asking, thanks Olapo, this is Olajide. He says, I'm really getting interested in stock trading despite no prior knowledge. You make it way easier than I thought. Okay, cool. I'm happy you're finding it easy. I still intend to start a proper class from scratch for somebody who wants to get into stock and investment. That class will probably be the next class I will do, which will be a basics class. Now, because this is technical analysis, this is for people who are already investing and just need to improve their investment knowledge. But I want to do a proper starting class from scratch. How do financial markets work? What are the different financial assets that you can invest in? How do you construct a portfolio? And that's going to be a lot more intense. So a lot more longer than this sort of class. So I'm hoping we can do that sometime soon. So Olajide, that would be one that you want to get interested in, and I think you will find it really useful. Okay, Edge Connect FX, I'm happy to have you on. Can I give you money to invest? No, sir. I do not invest funds for people. Primarily because regulatory reasons. I work in wealth management here, and I can't take funds for you. But if you do want to invest with our firm and you are based in Canada, I'm happy to introduce you to my team, and then we can manage funds for you. My business is wealth management here in Canada. We manage funds for high net worth individuals. So basic starting point for us is $250,000. If you have that and you have estates, you have trust, you have insurance, you have all sorts of assets you like us to manage for you, build them into a sort of portfolio where they can consistently grow, and then you can hand them over to your children. We can protect you from paying too much taxes by structuring your investments in a way that ensures that you are more tax efficient. You don't have to pay more tax than you're paying. Set up your charities and all that. We manage all that. So if you have that sort of interest, I'm happy to have a further discussion with you as well. Fantastic. Someone says, Babatunde says, thanks a lot, Dolakpo. I have attended all 3 classes on technical analysis and I started trading equities this past week. Looking forward to using the indicators discussed today for future trades. Fantastic. And as you use them, feel free to ask me questions on this YouTube link, which will be up soon. And I'll come back. I always check it every other week, and I will respond to your questions so that you learn, continue to learn more. And okay, again, you have the reading guides as well too. Okay, so moving on, I think I may have answered all the questions now. Moving on, let me talk about screening. Screening has to do with, is the act of using specific filters to reduce or whittle down the amount of stocks or assets that are in a selection of stocks and assets that you have, till you have a short list of no more than a few from which you can pick good investments. Now, because the thing is that, for instance, someone who has just started trading in foreign markets and so on, in foreign markets and so on, how do you decide which particular stock to buy? Now, I have a whole video dedicated to that, and that's why there's a link down here. This material will be available soon. Alternatively, you can go to my YouTube page and also check the link, and you will find a lot more information on how to screen. There are a couple of sites I use for screening. Finviz.com, Webull.com, Yahoo Finance, they are all fantastic sites. They have the screening app which allows you to select the filter. For instance, and what I mean by that is, for instance, let's say there are like 100 stocks in the finance sector. You want to buy a stock in the finance sector in the US. Which stock should you buy? They're like, let's say like 1,000 stocks. How do you know which one to buy? Now, you can select a filter that says, okay, I want to buy all the stocks that have a positive profit after tax in the last trading year. That's a filter. A screener app will automatically just remove every stock that does not match that parameter or that criteria from your list. Then you can also say, okay, out of this shortlist, I need only stocks that are trading below $50 per share. The screening app will take out all the ones that are trading above $50 per share. Then you have another shortlist. Then you can add another filter that says, okay, then I want to trade only the ones that have traded between a 5% to a 10% increase in price in the last 2 weeks. And the screening app will take out everyone that has not matched that particular criteria. So screening is fantastic, and it helps you to reduce the list so that you know that, okay, now this is a stock that has generated a profit after tax in the last trading year, as is trading below $50 and is currently on an upward trend and has risen 5% in the last 2 weeks. Then you know that this is within the range. And then you can now apply technical analysis to each of the charts as you look at it. So that's what screening is. And there's a whole class on that. There's a whole lecture on that or teaching on that on my YouTube page. So again, this is a good point to mention. If you haven't subscribed, please subscribe. The whole idea behind this is to create a place where I can pretty much dump all this knowledge in my head and just put it there for young professionals to also come and learn and improve their investment and career experience. And that's what the YouTube page for. So please ensure you subscribe, and you'll find all this material useful. Now, so after you finish screening, let's now talk about trading strategies. And I'll just check to quickly see if my friend article is up, if he's available, and okay. If that doesn't happen in this class, we'll make sure it happens in another class. Okay, let's see. Okay, so let's talk about trading strategies, which is the concluding part of this particular class. Let's talk about trading strategies. So how do you trade with all this, with technical analysis? How do you trade with technical analysis? There are three major ways that I would like to talk about today, and there are specific trading strategies that you can develop over time. I call them, those are trading systems, where you know that, okay, I only trade in a 4-hour window, and I only use Bollinger bands, and I trade only Bollinger bands that have this particular height or this particular width or so on. There are specific trading strategies, systems that people use, but I want to talk about general trading strategies. And there are three major ones. Number one is what we call scalping. Scalping is when you only buy and sell within the same day, but you only buy and sell within short trading opportunities. So for instance, you take a stock and you decide, oh, I just want to buy this stock at this price, and I want to, if it trades up, because you know, in foreign markets, in US markets, there's no limit to how a stock can trade within a day. So a stock can trade 100% within the same day. Unlike Nigeria, where the maximum a stock can trade is 10%, a stock can trade 100% the same day within the US market. So, and you can buy and sell within the same day. So scalping targets that. Scalping tries to look at the potential to gain, to make small wins, to make small gains and from stocks. So every day every day or every other day when you trade, you know that you are just targeting, you enter at this low price and you get a small increase, maybe 10% or 20%, pew, and you jump out. 10%, you're out and you move on. 20%, you're out and you move on. That is scalping. You're just picking small gains here and there from different stocks. When I used to trade for an asset management firm in Ikoyi, that was our strategy. We had several traders, and our strategy was we just scalp points, we just scalp pips. We're trading currencies and commodities, not really equities. So you just scalp pips in the market and you just jump out. You do that and you jump out. We don't do long trades. We don't trade over long days. We don't leave trades in the market overnight and so on. So that is scalping, and you can do that with equities as well. You can decide to buy a stock and sell it the same day. So far it matches, you make your gain from it. Okay, so scalping is good. And then there's what we call swing trading. Swing trading is based on longer term trends in the market. And it's fantastic in the equity space when you know that a stock is going to go up. So even if it is going up and down, but you know that the general direction is upward, then you can swing trade that stock where you actually ride it. For instance, that was what all of us were doing with Tesla. So we know that we bought it this week and we sold it several weeks later or a month later because we were swing trading it. So we know that the market has swung in a different direction and you just buy into that swing and you trade that direction till it gets to the end and you jump out. The problem with swing trading is that you may not know when the swing will come to an end if you are not constantly observing the market, because you are leaving your trade in the market overnight and over weeks and sometimes over months, and if you're not someone that monitors the market closely, you may not know when the swing has ended. Okay? Or for instance with Tesla, you don't know when Elon Musk will come out and tweet and say that this stock is overpriced, and then it will crash the market for you. So swing trading is longer term compared to scalping. And then number 3, which is the Warren Buffett style, is what we call holding a position. In other words, you buy a stock and you just hold it you can hold it for a year, hold it for years. And this is really good when you get a very good value stock, a stock that potentially you can buy cheap and you can sell, it can grow in value. This is for a company that you know has a lot of growth potential. I mean, take for instance, I had a client who bought a stock at $1, and this was several years ago, and this stock is currently selling at $17 today. Now that is a 1,700% increase in value. $1 to $17. We all saw what happened with Forte oil some years back when it went from $7 to 400, from 7 naira to 400 naira. So holding position is good. Warren Buffett would typically buy a stock and just hold it for a long period of time. He rarely ever gets rid of stocks unless it's time to take profits, and that's some years later. And that's why there was a bit of a noise in the market when he started to sell airline stocks, because they were like, wow, this is not your typical strategy. So at every point in the market, you're either someone who is actually trading, so you are scalping, or you're actually an investor. You're holding positions for a longer period of time. So you're not always trading, you're not always scalping, and that's what I try to dissuade a lot of people from, because you have to think about cost and you have to think about risk. When you scalp, you are essentially generating trading fees when you buy and trading fees when you sell. So it does affect your profit. So you have to be sure that that profit is actually real and it covers both your commissions on both the selling and the buying, or both buying and selling rather. So you do want to ensure that you actually are making good sales, because you are generating a lot of fees when you are scalping. So you can't scalp all the time. Sometimes you'll have to swing trade. Sometimes you'll have to hold some positions. Okay? In building your portfolio, you will have positions that you are going to hold for a long period of time, because they are value positions, they are income positions that will generate a lot of income in dividends and payments to you. And then there are scalp positions that are short-term positions you jump in and out, or swing positions that you jump in and out. So at every point in time, you're either scalping or swinging or holding. Okay? You are never just scalping alone. There was a young man I asked to be on this call. I don't know if he's on this call or this particular tutorial. He told me about a position he held in a market, and then one day he just wiped $2,000 was just wiped off his entire position. I told him, I said, look, you need to be on this tutorial. I want to talk to you about how to protect your trade, because that's the next thing we're going to talk about. So you need to learn that you're not always scalping. So don't always go into the market trying to scalp. If the market turns against you, and then occasionally if you're trading in foreign markets, because of internet connection, if your internet logs out and the market moves against you, which has happened to me before, you could, by the time the market reconnects and your internet reconnects and all that, you are in the red for $2,000. At that point, for me, it was minus $10,000. So you have to be careful. You have to be careful. So again, think about the cost and also the risk dimension. And let's talk about that a little bit more. But lastly, before this strategy, let me also say, as a strategy also, to also think about the potentially specializing in a particular sector or segment. Because when you specialize, then you become more knowledgeable about that particular segment, and it becomes easier for you to identify patterns and opportunities in that segment. I mean, you can wake me up from sleep and I'll tell you what's happening in crude oil, how to trade it and so on. I had my friend who was supposed to be on this call, Atiku, is a trader across currencies. He's fantastic with currencies, but when it comes to crude oil, we talk a lot, and I will tell him that, look, this is where I think prices are headed and so on. So because it's a market I know so well, and I've studied, I've done research, I've been in oil and gas for so long. So again, over time, as you start, think about potentially specializing in a particular sector and becoming good in either gold or cryptocurrencies or a particular equity category or so on, so that it becomes easier for you to trade. And honestly, that's where you make your money. Okay, let me read some questions. It says, Babatunde says, quick one, what do you think about Gilead stock, especially because the FDA approved their drug Remdesivir as an emergency treatment for COVID-19? Could you please reshape the screening slide again? Okay, reshare the screening slide. Okay, don't worry. First of all the materials will be available after the class. I would definitely oh, that was you. Awesome. Okay, cool. Okay, so all the materials for this class will be just 1 minute. I'm just chatting with my friend to see if it's available. All the materials will be available. So you'll see that slide again. And then on the question about Gilead stock that you asked, awesome. Gilead stock that you asked, Gilead. I was one of the big fans of Gilead, and in fact, what I did was I created a watch list for all the companies that were creating vaccines for COVID-19. So you had Gilead, you had GSK, which was using their own RNA program. You had what's the name of this other one? Ovivio or something like that. There were a couple of them. I created a watch list somewhere for them, so I was just tracking them. To be sincere, I haven't taken a position in any of them, and I don't think I will at this point because I think we're still far away from a real vaccine or cure. Remdesivir failed in some aspects, but also generated positive results in some aspects. I'm not sure about this FDA approval. It's an emergency thing. It's not a permanent one. So I don't know. To be sincere, I think it might be interesting to look at a lot more deeper. So I mean, I'm happy to, if you do your analysis on it and you come to me with questions again after this class, we can chat a little bit more. Okay. So hit me up on Twitter and let's talk some more about it. But do I think it's a good stock? I think it's one to watch. I think it's one to watch, and watching it basically at this point doesn't mean buying, but one to watch. Okay. So it turns out article was actually on the call on the class. It was the one that was asking about investing and so on. Okay, so if he's available, we'll move on to the we'll do the Zoom call. Let me just see if I can set that up briefly. Just give me a minute. Okay, he's not available right now, but he was on the call briefly. Let me just keep on answering a few questions before we go into the last two slides. Ademola Ogunaike says, my portfolio has doubled in the past week. How much do you suggest I take out? Do I keep reinvesting into perpetuity? Okay, so this is more of a strategy question here now because I'm someone that I'm very aggressive when it comes to taking profit. So once a trade hits my target point or my profit target, I take out my money and look for the next opportunity. And in some cases, it tends to be too early. And sometimes I feel like, oh, I should have waited and so on. But the best thing is set targets, set realistic, work with profit targets. So don't just leave trades in perpetuity in the market. at the very least, take out your capital plus some profit from the trade. That's usually the best way to go. So if you have a profit target you think is realistic enough, if, for instance, in this case, you've doubled your money already, I'd suggest you take your capital at least plus maybe a 50% profit, 70% profit, take it out of the market. You can leave some portion of trade in the market because you know that's just profit alone. So for instance, let's imagine you invested $200 in the market and that particular trade is now at $400. At least take $350 out of that trade, or $300 out of that trade, or $320, whatever, $350, above 50% of your profit out of that trade, and leave $50 in that trade. If it continues to rise up, that's additional profit for you. But if it drops after that, then you know that that was only profit you were trading. You've taken your profit out of the market, the bulk of your profit out of the market. So that's really a good strategy to go by. Set a good profit target, and once you hit that profit target, take your trade out. And if you notice that there's still support for it to continue going in a profitable direction, then leave some portion of your profit, but take your capital and some profit out of the market. So the market, it could easily go both ways. So I think at this point, if you are doubled your money, it might be a good time to take some money out of the market. He also says, additionally, volatility has been high, which is one benefit to get into the market, but stock price jumps, particularly in the US, have been difficult to explain in light of poor macro indicators. Okay, good. So that's why you have the fundamental analysis aspect. You have to ensure that you continue to read up on those news links so that you know what's happening with the US economy. And at the same time, this is why you watch a lot of the Bloomberg and so on, just so that you have a clear view of what's happening in the US economy, because those news items are very critical to you. Now, so any more questions? Let me see. So that's that. So again, go to the screening app, screening video I shared, and read some more about that. I will tell you a little bit more about adding fundamental analysis to your technical analysis of markets. Eddie's asking, hi Dolakwa, what do you think about timing and time in the market? Guess scalping and swing trading strategy. Okay, good. So, you know, we'd always talk about the fact that you don't time the market. Try not to time the market, because the thing is, and what I mean by timing the market is trying to, you know, it's like when you see an escalator and you are trying to get on the escalator and you're trying to get the perfect step on the escalator, so that as the escalator is just coming up, you just put your step on it. I think one of the most hilarious things I've seen in my life was when a couple of traditional chiefs came to CBN building in Abuja when it had just been built, and they were trying to get on the escalator to go to the governor's office, and this particular chief refused to get help. He wanted to step on the escalator, you know, by himself, but they were trying to tell him that, Chief, just put your leg, the escalator will take you up, don't worry. He was, no, you have to gauge it, and he eventually fell down anyway. So try not to time the market, but basically that's why you have strategies in the market. And again, you've sort of answered your question that, okay, so are you trying to scalp the market? If you're trying to scalp, work with your profit targets. In fact, let's go to the next page, which is really about how do you protect yourself in the market? Because a lot of people trade naked in the market. They're just trading. No protection, no strategy to protect themselves. Because you see, markets are highly volatile, and human beings, we are very emotional creatures. So there is a tendency for you to get emotionally attached to your investment and therefore make mistakes. So you have to be careful. Emotions can create problems in trading and investments. Traders must learn to master their emotions and also employ money management tactics to protect themselves from losing too much money in markets. I'm showing you a chart here, and if we expand this chart a bit, let me see if I can get it into an expanded window. Probably not. The red bar that you are seeing is the average loss per trade that traders make on a particular trading platform. I was looking at a particular trading platform, FXCM. On FXCM, this is the average loss per trade, and the blue bar is the average gain per trade. The first one you are seeing is the Euro USD currency pair. Now, in the Euro USD currency pair, the average trader makes more losses than gains. And this is across various currency pairs. If we look at it across equities and so on, it might be a different chart. So what is this telling you? This is telling you that there's a higher risk that you lose money than the risk that you gain. Which is why there is something in markets which we call money management. Money management is how you protect your trade in the market to ensure that you don't lose money. Okay? And it's part of your strategy. In addition to having all your indicators and chart patterns and all that, you need to have a good money management strategy for protecting yourself. Okay, and how do you do that? There are four key things I'm talking about here. Number one is use limit orders. So when you are trading on those platforms that allow you to buy US stocks, Nigerian assets, again, these things don't happen so much, but you can talk with your broker and set them up. There's what we call limit orders. Limit orders are after you have bought or after you have sold, if you're short selling, you also enter something called a limit order that protects, that says that at this point, sell this position I have bought if it rises to this price or if it falls to this price. So take for instance, you buy Tesla at 600. You set a limit order that says if Tesla rises to 700, sell it. That's my profit limit. If Tesla falls to 520, sell it. That's my loss limit. You must always enter limit orders when you are trading. Always, without fail. Always, without fail. Because you need to protect your profit and yourself from losses. What if the market swings and goes and just takes you out at that 520 and then still rises and goes to 800? That is why I talked about sector specialization, so that you understand the kind, and I also talked about back testing your strategy so that you know the potential loss that you could take before you go into a profit position. So you need to back test. You need to, protect yourself. Okay, by setting limit orders, stop losses that protect your profit. So now the rule of thumb here is that your profit should be at least 1.5 times higher than your loss. So if you buy Tesla at 500, at least if you are setting your profit target, you can set your profit target at 650 and then your loss position at 600. At 400, so that the highest you will lose will be 100, but the potential for profit is 150. That's what we're talking about. So now you can't just set that arbitrarily. You need to set that looking at your back testing information that, okay, this is the potential, and then looking at the chart and your technical indicators that, okay, this is the potential gain I could make in the market. So if you don't see that potential gain that you could make at least 1.5 times the potential loss, do not take that trade. Okay, do not take that trade. Number two is never risk too much capital on a single trade. Never risk too much capital on a single trade. Okay, don't always, if you have $4,000 to invest, don't put the entire $4,000 on one trade. Split it out. Okay, rule of thumb is that you should never put more than 10% of your portfolio in one trade. Never put more than 10% of your portfolio in one trade. There are times when aggressive portfolio fund managers may do more than that. It becomes what we call a concentration risk. The risk that if that particular part of your portfolio goes bad, it drags down the performance of your entire portfolio. Another thing is always set a maximum amount of loss you can take. If your maximum amount of loss is $100 in a portfolio of 4,000, in a portfolio of 4,000, for instance, maybe your maximum loss you can take would be $1,000 or $1,005. And if you are trading and you are taking losses, you know that, okay, once I get to this, I'm not doing this trade anymore. I exit from this trade. I take my loss and I move on. Because look, you will not always make profits, but sometimes you will take the losses and move on, especially if you are trading. But if you are investing and you are in a stock and the stock has gone down and stayed down for so long, until you actually sell that stock, it's not a real loss yet. But for trading, because you tend to be trading either derivative products or not necessarily straightforward market products, a loss has oftentimes will crystallize immediately. Let me give you a good instance. I bought WAPIC shares in Nigeria while I was still in Nigeria in 2006, 2007. I bought it at 15 naira per share. WAPIC insurance. As of today, I think WAPIC insurance is whether 75 kobo or 80 kobo. I haven't sold that position. I just left it. In that same market, I bought Lasako for 3 naira, 279, 2 naira 79 kobo, and then some other shares later for 3 naira 30 kobo. Lasako insurance. Lasako insurance is 250 kobo today. So all those positions are in the market, and I just left them because there's no point selling them. If I sell them, I'm taking a major loss. At the same time, we never know if the economy in Nigeria recovers. Potentially, I might still get good value for them, or hand them over to my children. So again, with equities, it tends to be that way. But with most other commodities and currencies and cryptocurrencies, the loss crystallizes almost immediately. So you have to set a maximum loss position. Number 4, which is the final one, which is I've learned a hard lesson from, is never average down more than once. We have a saying in Yoruba that that the person that steals crayfish to eat never steals just one. There's always a temptation to average down. Average down is when you have made a mistake of buying a security at a high price, then the market crashes and you decide, oh, this is a good way to reduce my average price for this security by buying at a lower price. It's a good strategy in itself, in the sense that it gives you an opportunity to recover. And I've done this several times. For instance, I did it with Dangote Sugar. Also in that 2008, 2010 window, I bought Dangote Sugar at the height of the market. I gave my stockbroker 50K and I said, please buy Dangote Sugar for me if you see it at a good price. I didn't give him a price specification because then I was still more of a novice in the market. And he bought Dangote Sugar at 50 naira per share. So he just bought 1,000 units for me. It was ridiculous. I was like, how do you buy at the top of the market? Because Dangote Sugar at that point got to 51 and just crashed. And fell all the way down to 18 or so. So when he fell to 18, I then gave him 100,000 and I said, look, buy more Dangote Sugar at this $18. So he bought at 18 naira and then he bought more at 18 naira. And then that reduced my average price, I think, to around 22 or 23 or something like that. And when Dangote Sugar rose to 27, because my average price had reduced to 23, I was able to sell at a profit. And I sold out at 27. So averaging down often is an opportunity for you to reduce your average cost price and then still sell out your entire position at a profit. But the problem is, oftentimes the market just keeps on going down. And if you keep on averaging down, before you know what's happening, you have invested more capital than you should have, and you are now your portfolio is now in a risk position. So what if the company just never recovers? So for instance, imagine I kept averaging down with WAPIC or with Lasako from 15 to 10 naira to 8 naira and it got to 50 kobo. What do you do? So what most people do if you want to average down is you wait until the market totally bottoms out, or you wait until you see the market swing back into a different position, then you can average, and you average only once. But the moment you average, that's the last one. Do not average down more than once. Now, if you employ all these 4 things I've taught you now, it will help you in protecting yourself when you are trading in markets. Now, this is again a beginner's class. If we're talking an advanced class, we'll be talking about using options to protect yourself. So you'll be writing call options or put options. You'll be doing what we call straddles or hedges in the market, and that's more for an advanced class. But even with this, you can protect yourself when you trade in the markets. Okay, the final slide, which is really just talking about what's happening in the market right now, is that we're in a market that is very volatile and mostly bearish. So you adopt different strategies when you're trading in different markets. When the market is bullish and things are generally going up, then you can buy at a low price and try to sell at a high price. But when market is bearish as it is currently, you try to buy at a high price. You try to do what is called short selling, and that's available in foreign markets on most platforms, where you can sell a particular security you don't have, because the broker will borrow it to you, and then you can buy back at a cheaper price. And the difference between the price at which you sold at the top and you bought it back at the bottom is your profit. So you can make profit when the market is going up and make profit when the market is going down. So in different markets, we trade in different ways. If there are more questions, I'll answer them. Otherwise, I think that brings us to the end of this particular class. So, ladies and gentlemen, that is really what you need to know about technical analysis for a beginner. And with this information, if you go back and make sure you listen to the two videos, both the previous one and this one, which will be available soon, you will understand how to use technical analysis to improve your investment experience, and I'm sure it would really help you. So please don't forget to subscribe, and also to tell your friends to subscribe. I want young professionals to be better. I believe the next generation should always be better than the previous generation. We had a lot of training from the generation before us, and we're trying to, and I feel there's that gap, because our generation is not providing as much training for the generation coming after us. I mean, I've tried to hire analysts for research and so on, and I feel there's that gap in training. So that's why we're doing all this free training. So take advantage of it, read, research, ask questions, and I hope it helps you. Thank you very much for attending the class. It's been 2 hours, and I'm trying to get my spring cleaning on today. So have fun and enjoy your weekend. Thank you.